Let's take a look at the macro outlook for the Australian economy. And of course, we have just had that NAB business update. Now, Saul Eslake, an independent economist, joins me now. Saul, good morning. Thank you so much for joining us.
It's a pleasure. Thanks for having me.
Pleasure. Now, that NAB business survey, it's anything but uplifting as far as I could tell. What's your view?
Well, certainly the headline figure showing an improvement in business sentiment from -9 to -1 is good news. I haven't seen the rest of the detail of that survey yet. In particular, I'd want to look at what it says about businesses' inflation expectations and their hiring intentions. But at face value, that suggests that the Australian business sector's continuing to show resilience in the face of the steep increase in interest rates that occurred between May 22 and November last year.
Yeah, interesting. I think Nadine was saying that the small business owners and the retailers are feeling under pressure, but that's not surprising. Let's just, before we move on to some of the other big events that we've had and the new ones coming on, you did an excellent paper on LinkedIn on immigration, which I'd really like to touch on, because immigration has almost been a little bit of a wild card this time around when it comes to the economy. Can you just briefly run us through your take on how the immigration levels have really impacted and whether or not it's a net positive, a net benefit, or it's too hard to really separate out between the weeds?
Well, a couple of things there. The chart you've just put up on the screen shows two proxies for net migration that come from the published ABS data on overseas arrivals and departures. They're usually used to measure tourism, but they can also be used to show net permanent and long-term arrivals, which is quite close to, but not exactly the same thing as net migration. And then there's another measure which has a lead of a month on that, that's based on visas issued by the Department of Home Affairs. And that chart, I think, clearly shows that the surge in immigration, mainly of students and temporary workers, that drove Australia's population growth rate up to 2.4% last year, the fastest in 51 years, has peaked and will gradually subside over the course of this year, probably back from over close to 500,000 in 2023 to something more like the norm of about 250,000 by the time we get to the end of 2023. Now, that surge in immigration that we experienced after our borders were reopened certainly added to pressure on costs, particularly for housing, but some other costs as well, and was therefore a contributor to the increase in the inflation that we've experienced since then. But it's also been a factor keeping Australia out of the so-called technical recession, that is consecutive quarters in a row of negative real GDP growth. We've actually had to two decimal places, 3 successive quarters of negative growth in real per capita GDP. And if population growth hadn't been as strong as it has been, more people would have been tossing the R word around during the last couple of quarters in particular. That's a short-term thing. And the other thing that I referred to in that article on LinkedIn was a study released by the IMF over the weekend, which looked at the longer-term impact of immigration on Australia, and it concluded that there are costs, particularly for housing, associated with as big an immigration program as Australia runs. Nonetheless, they find that on net, there are benefits to the Australian economy, especially arising from the talents that our immigrants bring with them. According to the IMF, 60% of migrants to Australia have some kind of tertiary qualification. And if you throw in tertiary qualifications such as TAFE or vocational education, then it's actually about 69%. And Australia, in effect, gets those skills for free. You know, we haven't paid for the training and education that our skilled migrants bring to Australia. Some other country, their country of origin, has paid for it. They have a higher participation rate in the workforce, so they're more likely to be working and, among other things, paying taxes as well as spending on goods and services in the Australian economy than the native born. So while the IMF, like others, acknowledges that there are costs in terms not just of housing but congestion on our roads and so forth, they make the point that concern over housing costs is better addressed through improving housing supply. Easier to say than do, of course, but better addressed by measures to boost housing supply than by cutting back immigration purely for that reason.
Okay, Saul, before we get to the next week's December quarter CPI reading, the labour market data that we saw last week, bearing in mind this does tend to be a volatile series, what was your take on the data?
Well, a lot of people focused on the fact that employment fell by 65,000, but that, of course, followed increases totalling well over 100,000 in October and November. And almost certainly, as is the case with the retail sales data, there has been some shift in hiring from December into November as a result of our aping of American retailing practices such as Cyber Monday and Black Friday. And that was evident in the retail sales numbers. I think it's part of the explanation for what we saw in the employment numbers. But I think the more important point out of the labour force data last week was that it showed that the adjustment that's going on to the slowing in the economy as far as the demand for labour is concerned is primarily happening through hours worked. That is, employers are reducing the number of hours that people are working. That means probably that it's also reducing the amount that they're in total getting paid. And while that's maybe not so welcome for the people who are working fewer hours than they'd like to, it's probably better from the point of view of the economy as a whole than having an increase in the number of people working no hours at all because they lose their jobs. So adjustments taking place in a more flexible way. And while I think the unemployment rate is going to rise further as 2024 unfolds, probably to at least 4.5%, I think that's going to occur not because people who currently have jobs lose them, so much as because people entering the workforce as recently arrived migrants, school leavers, university graduates and the like will find it harder to get jobs in 2024 than they have done over the past couple of years. But even so, if the unemployment rate gets to 4.5% by the end of this year, that will still be low by historical standards. And I think if inflation also falls as the Reserve Bank is expecting it to, and we'll get an update of that on the 31st of January, just over a week away, then the Reserve Bank will be well pleased.
Absolutely. So, of course, that is the all-important next week, that CPI reading. Australia generally would put interest rates up more than comparative economies such as the US and the UK. But this time round, the RBA has been a little bit more restrained, Saul. Which is this going to defer, even if we do get a good quarterly CPI, the rate cuts that might come first, particularly from the Fed?
Well, yes, I think that's right. I mean, I surmise, I can't prove this, and the Reserve Bank hasn't said so explicitly, but I surmise from their forecasts more than anything else that the Reserve Bank has made a decision to tolerate inflation being above its target for a longer period than its peer central banks in the US, Canada, New Zealand, the Eurozone and the UK in particular, are willing to tolerate inflation being above their target ranges. And that's one reason why the cash rate here of 4.35% is lower than the 4.5% in the Eurozone, the 5% in the UK and Canada, the 5 3/8% that it is in the US, and the 5.5% in New Zealand. Those central banks have slightly tougher targets than our Reserve Bank does, and they appear less willing to tolerate inflation being above those targets than our Reserve Bank is. That has meant that rates haven't risen as much here. Another factor in that, of course, is that because of our predominantly variable rate mortgage system, increases in official interest rates get passed on to borrowers more quickly and extensively than they do, for example, in the US, where almost all mortgages are fixed for up to 30 years. But the corollary of the Reserve Bank being less aggressive on the way up, as I think they've been, is that they will be slower to start bringing rates down than the Fed and the ECB and probably the UK and the Bank of Canada as well. And my own view is that market expectations and some forecasts that the Reserve Bank could be cutting interest rates as early as September of this year are misplaced. And after all, Australian households, unlike their counterparts in most other countries, are going to be getting tax cuts on the 1st of July. And while people who'll benefit from the tax cuts aren't necessarily the same people who've been hurt by increases in mortgage rates, from the standpoint of the economy as a whole, those tax cuts are probably worth the equivalent of at least two 25 basis point rate cuts. And the Reserve Bank will, of course, have factored that into its thinking about when it might be appropriate for them to start cutting rates.